What if the Arizona housing market isn't crashing, at least not yet, but instead quietly entering the early stages of something much bigger, something that most people won't recognize until it's already too late to react to it? Not something loud, not something dramatic, not something that immediately shows up in headlines, but something slower, something more subtle, something that builds over time beneath the surface until one day it becomes impossible to ignore. Because that's how housing markets usually move. They don't collapse all at once. They don't suddenly fall apart without warning. They change gradually, almost invisibly at first, and then over time those small changes begin to stack on top of each other until the shift becomes undeniable. And right now, in Arizona, especially in Phoenix, we're starting to see the kind of early signals that historically tend to appear before a much larger market adjustment begins to take shape. Now think back for a moment to where this market was just a few years ago. This wasn't just a strong housing market, it was one of the hottest in the entire country. People were moving in rapidly from other states, especially from higher-cost areas like California, bringing with them both demand and higher purchasing power. Investors were entering the market aggressively, buying homes not just for long-term living, but for rentals, short-term income, and speculation. Homes were selling almost instantly. In many cases, buyers didn't even need to see the property in person. Offers were being made sight unseen, inspections were being waived, and bidding wars were happening on a regular basis. Prices weren't just rising, they were accelerating at a pace that felt almost unstoppable. And if you were watching from the outside, it created a very specific kind of pressure, the feeling that if you didn't act immediately, you might miss your opportunity completely. That kind of environment doesn't just move prices, it shapes behavior. It creates belief. Belief that prices will continue rising, belief that housing is a safe and reliable investment, belief that waiting is the biggest mistake you could make. And once that belief takes hold across a large number of buyers, it feeds into itself. More buyers rush in, demand increases, prices rise even faster, and the cycle continues. But here's the thing about belief in any market. It doesn't last forever. It's not permanent. And when it starts to shift, even slightly, the entire market begins to move with it. Because markets are not just driven by data or numbers, they are driven by people, and people react to what they believe is going to happen next. Right now, that belief is beginning to change. Not all at once, not dramatically, but gradually. And what's replacing that confidence is something much more cautious. Buyers are no longer acting with the same urgency. They're no longer rushing into deals with the same level of certainty. Instead, they're starting to hesitate. They're starting to question. They're starting to take a step back and look at the market differently. And that shift, even if it seems small on the surface, is one of the most important indicators that something deeper is happening. When people think about a housing downturn, they usually focus on prices. They expect prices to be the first thing that changes. But in reality, prices are often the last thing to move. The first thing that changes is momentum. Momentum is what pushes a market forward. It's what makes buyers act quickly, it's what gives sellers confidence, and it's what keeps prices trending upward. And for years, Arizona had strong momentum. It had speed, it had competition, it had urgency. But now, that momentum is starting to fade. And you can see it in ways that might not seem obvious at first, but become very clear once you start paying attention. Homes are sitting longer. Listings aren't getting the same level of attention they once did. Buyers are taking more time to make decisions. Sellers are beginning to adjust their expectations, even if they don't fully realize it yet. And this reintroduction of time into the market is one of the most significant changes taking place, because time creates pressure. When a home sells quickly, it reinforces the idea that demand is strong and prices are justified. But when a home sits on the market, even for a few extra weeks, it starts to raise questions. Buyers begin to wonder why it hasn't sold. They start to question whether the price is too high or if something is wrong with the property. And once those questions begin, the psychology of the market starts to shift. Instead of buyers competing with each other, sellers begin competing with other sellers. And that is a fundamental change in how the market operates. Because during the boom, sellers had control. They set the terms, they received multiple offers, and they dictated the pace of transactions. But when homes start sitting longer, that control begins to slip. Sellers are no longer in the same position of strength. They have to adjust. They have to respond. And in many cases, they have to make concessions just to attract interest. At the same time, demand is not behaving the way it once did. It's not collapsing overnight, but it is weakening, and it's doing so in a way that is gradual and therefore easy to overlook. One of the biggest factors behind this shift is affordability. Mortgage rates today are significantly higher than they were during the peak of the market, and that has a direct impact on what buyers can afford. Even if home prices stayed exactly the same, the cost of borrowing has increased enough to push many buyers out of the market entirely. Monthly payments are higher, qualifying has become more difficult, and the overall cost of homeownership has risen in a way that changes how buyers approach the decision. But it's not just about affordability, it's also about confidence. Buyers don't just need to be able to afford a home, they need to feel confident in the timing of their purchase. They need to believe that they're making a good decision, not just financially, but strategically. And right now, that confidence is starting to weaken. Buyers are no longer assuming that prices will continue to rise. Instead, they're starting to consider the possibility that prices could fall, or at the very least, remain flat for a period of time. And that shift in expectation has a powerful effect on behavior. During the boom, waiting felt risky. If you waited, prices went up. If you waited, someone else bought the home. If you waited, you lost. But now, waiting feels different. It feels safer. It feels smarter. Buyers are starting to think that by waiting, they might be able to get a better deal. They might be able to avoid overpaying. They might be able to see how the market develops before making a decision. And when enough buyers begin to think that way, demand slows down. Not because people don't want to buy, but because they don't want to make the wrong move. This is what we can think of as the beginning of the waiting phase. And it's one of the most important transitions in any housing cycle. Because once buyers start waiting, the pace of the market changes. Transactions take longer, negotiations become more common, and sellers begin to feel the impact of that hesitation. It's not immediate, but it builds over time. And as it builds, it sets the stage for everything that comes next. And that's where we are right now. Not in a crash, not in a collapse, but in a transition. A shift in momentum, a shift in behavior, a shift in expectations. And those shifts, even if they seem small right now, are what come before larger changes. Because once momentum disappears, once urgency fades, once buyers start to hesitate, the entire structure of the market begins to change. And from that point forward, what happens next is no longer about what the market was, but about what it is becoming. Got it? You want it tight, continuous, paragraph heavy, no extra spacing so 11 Labs reads it smoother and longer. I'll keep the same depth but remove the broken spacing and keep it flowing like a true narration. Now that we've talked about demand starting to fade, we need to shift our focus to the other side of the equation, because this is where things begin to get more serious. Supply. Housing markets don't just change because buyers slow down. They change when supply and demand begin moving in opposite directions at the same time. And right now in Arizona, especially in Phoenix, that's exactly what we're seeing. Inventory is rising. And at first glance, that might not sound alarming. More homes for sale can sound like a normal, even healthy shift. But what matters isn't just that inventory is rising, it's how fast it's rising, and more importantly, when it's rising. Because when inventory increases during a period where demand is already weakening, that's when the balance of the market starts to shift in a meaningful way. More homes are being listed, more homes are sitting on the market, and more sellers are entering a market that no longer has the same urgency it had just a few years ago. And that change, even if it seems small at first, has a ripple effect that spreads across the entire market. To really understand why this matters, you have to understand how housing markets function at a basic level. In a strong market, inventory stays low. That means there are fewer homes available than there are buyers. And when that happens, buyers compete with each other. They bid higher, they move faster, and they push prices upward. But when inventory starts to rise, that entire dynamic flips. Now there are more homes than there are buyers, And instead of buyers competing with each other, sellers begin competing with other sellers. And this is where the shift becomes real. Because sellers don't want to compete. They want their home to stand out. They want it to sell quickly, just like homes were selling before. But when that doesn't happen, they're forced to adjust. And those adjustments don't usually happen all at once. They happen gradually, and then they spread. One seller lowers their price slightly, just enough to attract attention. That home sells. And now that lower price becomes a new reference point for the neighborhood. The next seller, seeing that result, adjusts their expectations. They list slightly lower or reduce their price after sitting on the market. And just like that, you start to see a chain reaction forming. This is what's known as the domino effect, and it's one of the most important processes to understand in a shifting housing market. Real estate is heavily driven by comparable sales, so when one home sells for less than expected, it doesn't just affect that one transaction, it affects every similar home around it. Imagine a neighborhood where homes were consistently selling for around $500,000 at the peak of the market. Everything feels stable, and sellers feel confident listing at or above that price. Then one home sits longer than expected. The seller gets nervous and drops the price to $485,000. It finally sells. That sale is now recorded as a comparable. The next seller enters the market, originally hoping for $500,000, but buyers point to that recent sale. Suddenly, $500,000 doesn't feel realistic anymore. That seller lowers their price to $490,000, then maybe to $480,000 to stay competitive. Now that becomes the next comp. And just like that, without any dramatic crash or major headline, the price level in that neighborhood has shifted downward. And this process doesn't feel dramatic when you're in it. It feels gradual. It feels almost normal. But over time, those small adjustments add up, and what started as a minor price correction becomes a broader trend. Now let's talk about the sellers themselves, because this is where the emotional side of the market starts to show. Most sellers don't immediately accept that the market has changed. In fact, many resist it. They look at past sales, especially from the peak, and they anchor their expectations to those numbers. They think, if my neighbor got that price, why can't I? So instead of adjusting right away, they wait. They hold their price. They hope the right buyer comes along. But time works against them. The longer their home sits on the market, the more pressure they feel. Not just financially, especially if they're carrying a mortgage, but psychologically. They start to question their pricing. They start to worry that they missed their window. They start to notice other homes in their area reducing prices, getting offers, and selling while theirs remains unsold. And eventually, many of them reach a tipping point where they decide to adjust. They lower the price. And once that happens across enough listings, it becomes a pattern. Price cuts become more frequent. Then they become expected. And once buyers begin to expect price reductions, the entire market dynamic changes again. Buyers no longer feel pressure to act quickly. They don't feel the need to make aggressive offers. Instead, they wait. They watch. They anticipate the price drop. And this is a huge shift from the behavior we saw during the boom. During that time, buyers were reacting to competition. Now they're reacting to opportunity. At the same time, something else is happening that often goes unnoticed, and that's the rise of concessions. Sellers, instead of immediately lowering prices, sometimes try to make their listing more attractive in other ways. They offer to cover closing costs, they offer mortgage rate buydowns, they agree to repairs they might have previously refused. These concessions are subtle, but they're incredibly important signals. They indicate that sellers are having a harder time attracting buyers at their current price. And while concessions can temporarily support pricing, they often precede more direct price reductions if demand doesn't improve. Now, when you combine all of this with rising inventory, you start to see how pressure builds beneath the surface. More listings mean more competition. More competition leads to more price adjustments. More price adjustments change buyer expectations. And those expectations feed back into the market, slowing demand even further. This is how a feedback loop begins. And once that loop is in motion, it can sustain itself. Buyers see prices softening, so they wait. Sellers see buyers waiting, so they lower prices. Lower prices reinforce buyer expectations, and the cycle continues. And this is where the concept of inventory overhang comes into play. When there are too many homes on the market and not enough buyers to absorb them, inventory starts to accumulate. Homes sit longer. Listings stack up. And the longer that overhang exists, the more pressure it creates. Sellers begin to compete more aggressively, not just for price, but for attention. And in some cases, it's not about getting the best price anymore. It's about getting out, especially for sellers who need to move, who are relocating, or who are financially stretched. Now imagine this scenario continuing over several months. Inventory continues to rise. Demand remains cautious. Price cuts become more common. Buyers continue to wait. At a certain point, the pace of decline can start to increase. Not because something dramatic suddenly happened, but because the underlying conditions have been building over time. This is how slow corrections can accelerate. Not through a single event, but through a series of reinforcing changes that gradually push the market in a new direction. And what makes this particularly important right now is that it doesn't feel like a crash. There's no panic, there's no urgency, there's no overwhelming sense that something is wrong. Instead, it feels like a normalization, a cooling, a return to balance, and that's exactly why it can be missed. Because by the time it feels like a crash, the majority of the adjustment has already taken place. Every market goes through emotional phases. It starts with optimism, where everything feels positive and upward. Then it moves into caution, where people begin to question whether the trend will continue. Then comes uncertainty, where behavior starts to shift. And eventually, if conditions continue to deteriorate, that uncertainty can turn into fear. Right now in Arizona, we're in that middle phase. Caution moving into uncertainty. And that's a critical point, because from here, the market can stabilize, or it can accelerate in the opposite direction. So when you step back and look at everything together, you start to see the bigger picture forming. Rising inventory, weakening demand, increasing price cuts, growing concessions, shifting buyer behavior. These are not isolated events. They are connected. They are part of a larger transition that is unfolding in real time. And while it may not look dramatic on the surface, it represents a meaningful shift in how the market is functioning. And the longer these conditions persist, the more important the next phase becomes. Because in the next part, we're going to take this even further. We're going to talk about what happens when price declines become more visible, when investors begin stepping back more aggressively, and when confidence starts to break at a larger scale. Because that's the point where markets don't just shift quietly anymore. That's the point where people start to notice. Now that we've talked about demand weakening and inventory rising, we need to move into the next phase of this shift, because this is where things start to become much more visible, much more real, and much harder to ignore. Price declines. And this is the part of the market that most people focus on first, but in reality, it's usually not where the story begins, it's where the story starts to become obvious. Because by the time prices are clearly moving downward, a lot of the underlying changes have already been in motion for months, sometimes even longer. And that's exactly what makes this stage so important to understand, because it's the point where quiet shifts begin to show up in ways that people can actually see and feel. In Arizona, prices have already started to come down from their peak levels, and while those declines may not look dramatic at first glance, they matter much more than they seem. Because even a small percentage drop can have a large impact on how people think about the market. For years, the expectation was simple: prices go up. That belief was reinforced over and over again as buyers watched values climb year after year. But once that trend breaks, even slightly, it introduces something new into the equation: uncertainty. And uncertainty changes behavior faster than almost anything else in a market like this. When buyers start to believe that prices could go lower, they begin to hesitate. They begin to question whether now is the right time to buy, or whether waiting might actually put them in a better position. And this is where things start to slow down even more, because declining prices don't just affect affordability or value, they affect timing. If buyers think prices are falling, they don't feel urgency, they feel patience. They step back, they observe, they wait for a better opportunity. And when enough buyers begin to take that approach, demand weakens further, not because people have disappeared from the market, but because they've chosen to delay their decisions. And that delay feeds directly back into pricing, because fewer active buyers means fewer offers, and fewer offers means sellers have less leverage. Yeah. Now let's take a closer look at how these price declines actually play out in real time, because it's not usually a straight line downward. It's uneven. It's inconsistent. It happens in pockets first, certain neighborhoods, certain price ranges, certain types of homes. You might see one area where prices are holding steady, while another area starts to slip. And that can make the overall market feel confusing, because there isn't a single clear direction at first. But over time, those localized declines begin to spread, and as they do, they start to influence the broader market. Let's imagine a scenario where a homeowner purchased a property at or near the peak of the market, maybe in 2021 or 2022, when prices were at their highest and competition was intense. At the time, that purchase made sense based on the conditions that existed then. But now, with prices softening, that same homeowner might find that the estimated value of their home has dropped by 5 or even 10%. Now on paper, that might not seem catastrophic, but psychologically, it's significant. Because for many homeowners, their property represents not just a place to live, but a store of wealth, an investment, something they expect to appreciate over time. And when that expectation is challenged even slightly, it can change how people feel about the market. Some homeowners may choose to hold and wait, believing that the market will recover. Others may become more cautious, especially if they were considering selling or refinancing. And in some cases, particularly for those who purchased recently with smaller down payments, declining values can begin to create financial pressure. Not necessarily immediate distress, but a sense that their position is more fragile than they expected. Now layer that on top of what's happening with investors, because this is another major piece of the puzzle that can accelerate everything we've been talking about. During the boom, investors were a powerful force in the Arizona housing market. They added demand, they increased competition, and in many cases they helped push prices higher than they might have gone otherwise. But investors are not driven by the same motivations as typical home buyers. They are focused on returns, on risk, on timing. And when market conditions change, their behavior often changes more quickly. Right now, we're starting to see signs that investor activity is slowing down. Large institutional buyers are becoming more selective. Smaller investors are reevaluating deals. And in some cases, properties that were purchased with the expectation of continued appreciation are no longer performing the way investors anticipated. And when that happens, investors don't always hold. Sometimes they sell. And when investors begin to step back or exit the market, it removes a layer of demand that was previously supporting prices. This is important because investor demand is not just an addition to the market, it's an amplifier. When investors are active, they increase competition and push prices upward. When they pull back, that effect reverses. There's less competition, more available inventory, and more pressure on sellers to adjust. And if investors begin to sell into a market that is already experiencing rising inventory and weakening demand, it can accelerate the pace of price declines. Now combine all of this, declining prices, cautious buyers, rising inventory, and reduced investor activity, and you start to see how the pieces fit together. Each one of these factors reinforces the others. Lower prices cause buyers to wait. Buyers waiting causes demand to weaken. Weak demand causes more price cuts. More price cuts affect comps. And lower comps put pressure on every seller in the market. This is what we call a feedback loop, and once it begins, it can sustain itself without any single triggering event. And this is the stage where confidence becomes the most important variable. Because markets don't just move based on supply and demand, they move based on how people feel about supply and demand. If people believe the market is stable, they behave one way. If they believe it's declining, they behave another. And right now, confidence is starting to shift. Not collapsing, not disappearing, but changing. Moving from certainty to caution, from urgency to patience, from confidence to questioning. And that shift in confidence is what ultimately determines how far a correction goes. Because if confidence stabilizes, if buyers regain trust in the market, if conditions improve, then price declines can level off. But if confidence continues to weaken, if buyers keep waiting, if sellers keep adjusting, then the pace of change can increase. And that's when a slow correction can begin to feel much more like a downturn. Now, it's important to say this clearly, because this is where a lot of people misunderstand what's happening. This is not necessarily a crash, at least not at this stage. What we're seeing is a process, a progression, a series of shifts that build on each other over time. But within that process are the same patterns that have appeared in past market cycles: rising inventory, weakening demand, early price declines, shifting psychology, and changing investor behavior. And when those patterns appear together, they create the conditions where a larger move becomes possible. And this is where we have to start thinking about scenarios, not predictions but possibilities. What happens if prices decline another 5%? What happens if they decline 10%? What happens if external factors like interest rates or the broader economy add additional pressure? These are not guarantees, but they are outcomes that become more likely as the current trends continue. So when you step back and look at everything together, you begin to see that this is not just a series of isolated changes. It's a connected shift, a transition from one type of market to another, from a market driven by urgency and rapid price growth to a market defined by caution, adjustment, and reevaluation. And that transition is still in progress. It hasn't fully played out yet. But the direction of that transition will depend on what happens next, how buyers respond, how sellers adjust, and how confidence evolves over time. Because once confidence breaks in a meaningful way, that's when markets don't just drift downward anymore. That's when they start to move with more speed, more visibility, and more attention. And for many people, that's the point where it finally feels real. Now, I want you to really take a step back for a moment and think about everything we just talked about, not just as information, but as a pattern, as something that's actively unfolding in real time. Because what's happening in the Arizona housing market right now isn't just about prices going up or down. It's about a shift in behavior, a shift in expectations, and more importantly, a shift in confidence. And those shifts, even when they seem small at first, are what eventually determine where the market goes next. Because at the end of the day, the housing market doesn't move because of headlines, and it doesn't move because of predictions. It moves because of people and how people feel about buying, selling, and waiting. So if you were in the market right now, if you were thinking about buying a home or selling one, or even just watching from the sidelines, the real question isn't just what prices are doing today. The real question is how you feel about what prices might do next. Do you feel confident stepping in right now? Or do you feel a sense of hesitation, a sense that maybe waiting could put you in a better position? Because that hesitation, that pause, that moment where you stop and reconsider, that's where market shifts begin. Not with panic, not with sudden drops, but with small changes in behavior that spread from one person to the next. And right now, we're starting to see more of those moments. Buyers taking their time, sellers adjusting expectations, investors stepping back and reevaluating. And all of that adds up to something much bigger than any single data point. It adds up to a transition, a market that is no longer driven by urgency, but by caution, no longer driven by competition, but by comparison. And that kind of transition doesn't happen overnight, but once it starts, it has a tendency to continue until a new balance is found. Now, the important thing to understand is that we're still in the middle of this process. This isn't the end of the story. It's the beginning of a new phase. And what happens from here will depend on a number of factors: how buyers respond, how sellers react, how interest rates move, and how the broader economy evolves. But the foundation for change is already in place. The early signals are already there. And for the people who are paying attention, that matters because it means you're not reacting after the fact, you're seeing things as they develop. And that's really what this comes down to: awareness. Understanding not just what's happening, but why it's happening and what it could lead to next. Because markets reward the people who pay attention early. The ones who don't just follow the trend, but recognize when the trend is starting to change. And right now, whether this turns into a mild correction or something more significant, one thing is clear: the Arizona housing market is no longer what it was just a few years ago. It's shifting, it's adjusting, and it's entering a phase that will define what happens over the next several years. So if you've made it this far, if you've been following this breakdown and thinking about how it applies to your own situation, you're already ahead of most people. Because most people don't start paying attention until the shift becomes obvious, until the headlines catch up, until the opportunity has already passed or the risk has already increased. But you're here now, seeing it as it unfolds, understanding the pieces as they come together, and that puts you in a different position. And if you want to stay in that position, if you want to keep understanding where the market is going instead of just reacting to where it's been, make sure you like this video, subscribe to the channel, and turn on notifications because we're going to keep breaking this down step by step as things continue to evolve. Because this story, what's happening in Arizona right now, it's not isolated. It's part of something bigger, something that could extend into other markets, something that could shape the next phase of housing across the country. And the truth is, we're still early in this shift. The full impact hasn't played out yet. The direction isn't fully decided. But the signs are there, the patterns are forming, and the next chapter is just beginning. So hit that like button, drop a comment Arizona below if you think this applies to you. Stay aware, stay informed, and I'll see you in the next video.